Thank you to those of you who are here on time. So we'll kick things off, and we'll kick things off also for the people who are online. As I mentioned earlier, this is being recorded and there are a whole lot of people listening online. So last time I looked, there was about 50 people registered online. So the boardroom wouldn't fit everybody in, but you guys get the benefit of the free food and drinks. Please attack the drinks up the back anytime you want. I'll also introduce myself. My name's Robert Shelton. I'm Managing Director of business here. And down the back is Melissa Healy, the second of the three directors. The third of the three directors may be online, but he's isolation at home with COVID, as is a number of our team at the moment. So hopefully they'll all get back on deck shortly. We will be talking about the federal budget tonight. All right. So there's plenty of alcohol because that's usually what's needed next to a federal budget.
Get through it.
Okay. One of the things that you won't be aware of is that in Canberra, there is a tradition of the federal budget breakfast, which is immediately after the federal budget on the Tuesday night. On Wednesday morning, the Great Hall of Parliament House is filled with 1,000 accountants, and we all sit in there and they tell us what happened in the federal budget, and we get to have question and answer session and so forth. And this year was the 25th anniversary of the federal budget breakfast, and I've got the pin that says that I've been to more than 20 of them, which makes me a true budget tragic. The difference is I haven't ever been to the lockup, and I have no desire whatsoever to go to the lockup, for those of you who are into these things. So I've been around for a little while and I know what goes on with these things. So today we're going to talk about individuals, businesses, superannuation, and a bit of tax planning just to finish up with. Okay. All right. So the thing about budgets, and if you've been in Canberra, you can't avoid sort of having to deal with budgets here and there. But the thing with budgets is always contemplate the but. Right? And the but is what will get through the Houses of Parliament. And this time in particular, what will get through the Houses of Parliament before they get suspended for the election. Right? And that might be, you know, I heard a rumour, which I haven't been able to listen to the news today, I've been tied up, but I heard a rumour that Morrison was going to jump in his car and go to the Governor-General now so that Parliament would be suspended so that Anthony Albanese wouldn't get to do his budget in reply speech at 7:30 tonight. Right? And that would be a great political sort of stunt to pull. So I don't know if he's done that. If not, I expect you'll all be dashing home from the office here, and for those of you online, you'll be dashing into your lounge room and turning on the 7:30 budget and reply speech and sitting on your sofa and do what I did on Tuesday night, which is gradually fall asleep. Right. So what gets through? So when I'm talking about things tonight, some of these things are announcements, but they may not be enacted, and some of them might never be enacted. All right. And you'll see shortly there's some announcements from last year's budget that actually only got legislated last week. Okay. So what might get through after the election? Will the new government of whatever flavour continue with these announcements, or will they throw them out? There's always a lot of uncertainty. And if they do all of that, there's still a question of what will be the effective start date for these things. Okay. So always bear that in mind. Anything to do with the budget, will it be enacted, and by whom, and with what start date? Okay. Right. The announcements for individuals. Okay. The big one is LMITO, which is being referred to as Lamington, which is the low and middle income tax offset, which in good Australian tradition has been turned into the Lamington. The Lamington has been extended for this financial year, and you'll get up to $1,500 depending on your taxable income. The higher your taxable income, the more it starts to shade out. If you earn more than $126,000 in taxable income, there's nothing for it, right? You don't get it. This one-off benefit is credited to you when you lodge your 2022 tax return. So for people who have got very simple tax affairs, they want to get their tax returns in real fast because there's a $1,500 tax rebate coming to them. Right? For people who have got complex affairs who are used to paying large amounts of tax, well, it'll be $1,500 less, but you may not be so excited to get diving in to do it. Okay. The incentive there is get your tax return in, and that will play well to lots of people whose affairs are a bit simpler. As you would all be aware, the fuel excise was halved as of budget night on Tuesday night. Okay, that fuel excise you pay at the Bowser, you don't know, you probably do know, but you curse it. There's a 45-cent fuel excise. I know you don't pay it, Peter, because you've got an electric car. I can see that smirk. Right, and Bob's sitting up the back. Bob's our financial planner. He's got the same smirk, and yes, you've got the same electric cars.
You'll join us one day.
Oh, you got to win too.
No, I was just saying hi, Bob.
So that's halved for 6 months, right? 22 cents a litre off. 2 comments about that. First of all, if you are operating, and this might be more for our online tribe, if you are operating in an industry that's entitled to the fuel tax credits for off-road use, so that's farmers, heavy machinery and so forth, that diesel fuel credit is not going to be effective for that 6-month period, because that credit is effectively not happening when you've got a half discount anyhow. Right. So that's the first comment on that. The second comment, more relevantly, is it's going to be really, really exciting and really, really interesting to see how they turn it back on again. Right. It's going to be a political problem to get it turned back on. Okay. In 6 months' time, somebody's going to go, righto, as of tomorrow, the 22 cents a litre is back on, and there's going to be fighting and queuing and car crunching and all manner of brawling as people try and get that last fill up, and they're going to take their 44-gallon drums, and how are they going to get this turned back on? It's really easy to turn off a tax. It's a lot harder to turn it back on again. Right? And the fearless prediction that could prove to be utterly incorrect is that they're going to find that they have to stagger the turn back on. They'll put on 5 cents this month and 5 cents more next month, and it'll be staggered back up. The chances of going from no fuel tax, or half fuel tax, back to 100% fuel tax, gee, that'd be a brave government that does that. So interesting process. A whole lot of the thresholds are indexed, so the low income threshold, various rebates, various Medicare thresholds, they've all been indexed. I'm not going to bore you rigid with that any worse than I already am. More excitingly, if you are still employed and your employer says, look, you've told me you've got a sniffle and a snuffle, we want you to get a COVID test. A COVID test is a tax deduction if your employer says we need you to do that before you can come back on site. Okay. Keep your receipts. If you're an employer, and I know we've got a number online, if you're an employer, providing COVID tests to your employees is an exempt fringe benefit. It is a fringe benefit, apparently. I'm not quite sure how they see the benefit of that, because most people don't like having probes stuck up their noses, but it is supposedly a benefit. But the government has come out and finally, a bit too late, and said no FBT for employers who provide these rats around the place. And also, last, in terms of what might impact on individuals, changes to the paid parental leave scheme. There used to be one rule for the maternal mother or the adoptive mother and a different rule for the father. They've now basically said, work it out between you. There's 20 weeks of paid leave, and who takes it and how much you take, work it out between you. Right? And there can be some apportioning around that. There's a few little tricks to that, but I'm not going to go into that in any great detail. So that's the individuals. Really, Lamito, the Lamington, and the fuel tax, and that's pretty much it. But just for the sake of completeness, they didn't talk about what they were doing with tax rates, because they're not doing anything new. All the announcements in relation to individual tax rates were made 2 years ago. So for your reference, and if you're excited by these things, I know it's very numerate. The current 2022 tax rates are in that second column. So the first $18,000 is tax-free, 0%. From 18 to 45,000, you're paying 19%. From 45 to $120,000 of taxable income, you're paying 32% on the extra bit. Then you go to 37%, then you go to 45% once you're earning more than $180,000. Every one of those positive rates, 19, 32, 37, 45, you've got to add the 2% Medicare levy to that in addition. Government tries to convince us that 2% Medicare levy is not a tax, but it looks like a tax, it walks like a tax, it behaves like a tax, so yeah, whatever. For 2023, no changes. 2024, no changes. It's the same. In financial year 2025, which the government keeps saying is 2024, it's all changing, but it's actually for the 24-25 financial year, right? There is some changes. At that point, there's going to be a 30% tax rate, and they're collapsing these two rates of 32.5 and 37. They're being collapsed, and everything sits in this 30% tax rate all the way through to $200,000. And if you're over $200,000, then you cop the 45% tax rate. They announced this 3 years ago, okay? And at that point in time, I stood up in this forum and said, there are there's two elections and 7 budgets before this happens. Watch it not happen, okay? And I'm going to stand up and say I got it wrong. There's actually only going to be 2 elections because this government actually managed to go a full turn, which 2 budgets ago was actually quite unusual for any government in Australia for 12 years at that point in time. So there will be another election before that happens. Watch this get changed would be my observation. But that's what's announced. That's what's currently in law. Law that's made 3 years in advance is always a bit dubious. We still have the Lamington. The Lamington starts at 675. So if you're in the low income bracket, the minimum Lamington is 675 and the maximum is 1,500. You get the maximum if your taxable income is on $90,000. Once you go past 90,000 towards 126, it starts shading back down until eventually you get nothing. Okay. So you can all sit there and stare at that and go, I'm in that bracket, or I'm in this bracket, or I'm in the other, or I don't want to get to that bracket. Or you say, as one of my clients did, my target is to get into that bracket. Good stuff. So what does all that mean? The budget was boring. Wasn't much in it for individuals. It is what it is. So yeah, yay.
The good news is there wasn't much changes, at least for us.
As a technician on these things, you know, a boring budget is actually good because it means we don't have to swat up on thousands of pages. This is actually the thinnest. I'm holding up a piece of paper for those online. This is actually the thinnest federal budget summary that I've seen in about 20 years, which is kind of interesting. Okay, but only if you're me. All right, businesses. There's more changes for businesses, but not a lot. Okay, that looks like a lot. It's actually not. The 2 big announcements that they want you to pay attention to in business. Number 1 is external training costs for employers. So employers who send their employees to an external training cost, right, will get an extra 20% tax deduction over what you spend. So if you spend $1,000 on training, external training course, you'll get an additional $200 of tax deduction on money you didn't spend.
Does that include your sole trader?
Yes.
So you can put yourself into a course.
So long as it's the sole trade, well, it's got to be for your employees, not for yourself.
All right. So if I have a company, but I'm the sole employee of that company,
That would be okay.
that's okay.
But if you're a sole trader training yourself, that's not okay.
Oh no. I knew that.
Okay, so there's a couple of conditions on this. Must be delivered by an Australian entity. They want your training money going into Australian companies. Fine. It can be delivered online or in person. And there's an open question at the moment. When they've said external training courses, it does that mean it has to be conducted on somebody else's premises, or could you get an external training provider to do the training on your premises? That's not quite clear at the moment. At the moment, we only have a press release and a budget paper that's only 2 paragraphs long as to what this is. So it's, you know, a bit open to further information. This one is capped. Costs are only, this is only available for costs incurred through to 30 June 2024. All right, so that's 2.25 tax years, okay, that it will be in. And there's one catch, all right, and it's only a little catch. They've said it's open for any training expenditure that you kick off after budget night, so Tuesday this week. Okay, so you think, oh great, I'll do, you know, March, April, May, June. I can do a bit of training. I'll get that extra 20%. They're not ready. So the extra 20% that you spend of money that you've spent in this financial year will actually be in the tax benefit in the following financial year. So you won't get the benefit of that for about 15 months at the earliest. Okay, and the reason they've had to do that is real simple. It's too late for them to change the 2021 company and individual business tax forms to put that extra box in to achieve that. All right, it's about 3.5 months programming time, and they've already issued the final instructions for the 2021 tax returns. So they simply can't do it. All right, so you'll get the benefit of it, but it will be delayed well past the 2021 tax return. It will be a benefit in your 2022 business tax return. Okay, so just a little catch on that. They haven't really publicised the fine print on that one. They want you to go, yay, we'll spend lots of money, but the detail is it's going to be a bit further down the road. And of course, this hasn't been passed yet. This is still a proposal. The other one they want businesses to adopt on, these were their two big headings for businesses. The second one, digital adaptation and the adoption of digital technologies. Businesses that spend money on that will get a 20% additional tax deduction for that spending. Right? So this is designed to get people to buy, tradies to buy digital terminals to walk around with, so you can pay on the spot, to move their business into the cloud, where it's probably going to be more secure, hopefully, than what it is sitting on a computer desk in a secure office somewhere. Right? And to adopt more cyber security, more secure policies and so forth. Right? These two are actually linked. It's one thing to have all the software and technology, but you need to train your people in that as well. So it is actually a smart thing to do both at the same time. So an extra 20% deduction, spend $1,000, get an extra $200 as a tax deduction on that. Fantastic. This one they've capped, all right, in the announcement. So up to $100,000 for the year, right? And then you get a 20,000. If you spend 100 grand, you get 20 grand of additional tax deduction. Fantastic. Okay. What can you spend it on? Websites, cybersecurity, hardware, cloud subscriptions. It's pretty open. We have, again, just a press release and a couple of paragraphs in the budget papers at the moment. Expect the tax office to come along and give us some more guidance, and they'll probably want to narrow it because at the moment it's pretty broad, right, the way it's been announced. Okay. This one's also capped. Costs have to be incurred by 30 June 2023. So this one's only 15 months long. Whereas that one's the first one is 27 months long. Okay, so just a little gotcha in there. And once again, the digital adoption, extra 20% benefit you won't get until you lodge your 2023 tax return, because they're not ready for it yet anyway. Right? They haven't changed the boxes in the tax returns. Okay, so you get it in 2023. That says 2024. That's a typo. That should be 2023. Okay, those are the two big things that every small to medium business is going to be super excited about. Small to medium means anything up to $50 million in turnover for this purpose, and that's aggregated group turnover. Right? So it's pretty broad, it's pretty wide, it's a good thing, and it's encouraging the right stuff, hopefully all spent in Australia, although heaven knows how many people will dash off and buy their Harvey Norman big screens, and that money will go over to China anyway, but we're going to talk about that. Okay. Some other smaller things that probably apply more for our online businesses than perhaps some of the businesses in the room here, but there's changes to the apprenticeship wage subsidies. Apprenticeship subsidies went up during the COVID years, and they're now basically, the new announcement is basically the return to what it was before the COVID years. So they're saying, hey, isn't this good? And it's anybody with a memory of more than 3 years goes, actually, that's what it was before we had COVID. So that's where it's landed. Good, so be it. For those who want to do employee share schemes, sorry for the acronym, employee share schemes for unlisted companies, there's changes to the Corporations Act to enable that to be a little simpler. We can deal with that offline if need be. Mentioned before, fuel tax rebates for our business clients that are getting fuel tax rebates effectively for the 6 months when the excise is halved. There will be no fuel tax rebates, so businesses are not going to get any sort of benefit out of that in that sense. Right. And there's a whole lot of technical amendments to a lot of small stuff that I'm not going to go into in any great detail there. Any questions on this from in the room? No? Good. Yes.
Got a quick one, maybe too intricate for now.
Yes.
That is, what is the definition of training? That's the main one.
Yep.
I'm a business advisor and coach for small business owners.
Yep.
Would my service be included in that for my clients?
Excellent question. All we have at the moment is the press release and the budget paper. I would expect the tax office will come out and give us some guidance on it. The question that's probably going to be at the tightest point is, will you be required to be a registered training organisation to deliver the courses that will be eligible? And I wouldn't be at all surprised if the tax office does try to scope it down and say you've got to be an RTO, right? But we don't have any detail on that at the moment. And right now, I had a couple of people saying that even today, I can send my team to the first aid course, You know, and we'll get a 20% benefit. We were going to do that anyway because we have to under the health and safety rules, you know. And another guy said to me yesterday, you know, half his people don't have the forklift ticket, right? Which in the ACT, it's arguable if you've got the smallest forklift as to whether you are required to have a ticket or not. He said, well, you know, if I'm going to get a 20% bonus for it, I might as well get the people to do it. And then, you know, I'm not in this grey area. So it's already starting to generate a bit of conversation around these things. Okay.
And similar to that cybersecurity thing now, one of my clients is a cybersecurity consultant.
Yep.
I suppose he would be included, or are there pitfalls to be expected along the way there as well?
So hopefully it will be as broad as what they've announced. And I get a bit cynical in my old age. I've seen lots of announcements come out where it looks really good on budget night, and then the tax office comes along and says, no, they didn't mean it to be that wide, they meant it to be only this wide, and they narrow it. That's kind of a regular feature. Part of that's probably fair enough. Part of it is also that their job is to protect the revenue, not to encourage behaviours.
I assume there's no Australian content requirement for the digital adoption.
Not at this point in time, no. And when you're talking about buying hardware and mobile devices and so forth, there's bugger all of those that are actually made in Australia. But you probably have to buy it in Australia anyway. Okay, we'll move along. For those of you who are operating through companies and corporate entities, no changes were announced to the company tax rate. The changes that have been around for a little while, there are actually 2 company tax rates at the moment, right? And there have been now for a few years. All companies that are large or don't qualify for this special treatment are down the bottom. There's a 30% standard tax rate for all companies that aren't special. Special are what's called base rate entities, and I'm sure that will burn into your memories and be something that you will remember forevermore. Base rate entities are active trading small businesses, okay? And there are a whole lot of conditions and tests and hurdles to prove whether you are or you aren't. But if you are a base rate entity, the tax rate is 25% on the company profits, okay? So no changes to that. It's like pretty boring because that's been the case now for a few years. It also means that if you are a base rate entity, your franking credits are at 25%, whereas if you're a large business, your franking credits are at 30%. So some of you will have a mixture of those in your tax returns too. Okay. What they did say on budget night, but it wasn't new news. I've left it in here, particularly for our business clients. The instant asset write-off will continue for the financial year 2023. So that's this financial year and next financial year. You can take an instant asset write-off for expensive items, which is fantastic. Okay. There is, if you're over $5 billion, there's got to be new stuff. Don't worry about that. If you're under 50 million in turnover, it's new or second hand. At the budget breakfast, the Minister for Finance, Michael Sukkar, was asked a question from the floor. Right now, if you go in and order a truck for a trucking business, it will be 18 months to delivery. Right? Okay, large trucks, 18 months. Right? It used to be 8 weeks, it's now 18 months. Thank COVID for that. Okay. The tax deduction is only available to you when the item of equipment is installed, ready for use. Okay? So if you order your truck today, it is quite likely that it won't be delivered until after the end of the 2023 financial year. Right? And accordingly, you wouldn't get the benefit. So Michael Sukkar was asked, are they reviewing this given the supply chain problems and the supply side problems that are causing these very, very long delivery times? And you think, oh, that's just large trucks. If you go to Mr. Toyota tomorrow and say, I want a new Land Cruiser 300 series, they will tell you that their delivery time is approximately 18 months, and they won't even guarantee that. But you still have to put your name down and pay your deposit to get into the queue to get one day, maybe perhaps when they get around to delivering it to you. Okay. One of our managers 6 months ago put in an order for a Toyota RAV, I think it is, and was initially told it would be a 10-month delivery period for the Toyota RAV. She said, but I need it because I'm pregnant and I'm only 7 months off delivering. And they said, tough, you'll get it after you've delivered. Fortunately, there was some sort of cancellation and she was able to slot in and get one just before delivering. But that's the kind of timeframes that are involved for a lot of these things at the moment. If you're in the new car market, for anything of good value, serious cars, you know, there's a lot of very cheap runabouts that you can get a little more easily, but a lot of the more solid and reliables, your standard Toyotas, 8 months, 10 months, 12 months, and 18 months for the 300 series if you're into those. So will this continue past the 2023 financial year? They haven't answered the question, and Michael Sucker yesterday morning would not answer the question. And he said, I'm not going to answer it. We're just going to watch and see what happens where the supply chains shrink back to what they used to be. Right? And for our electric car enthusiasts, that you've already got it, that's cool. But a lot of electric cars made in Europe had their wiring looms come from Ukraine. Right? So BMW closed their factory where they do their manufacturing for 2 weeks last month. Land Rover closed their factory where they do their manufacturing for 4 weeks, and various others are saying they're running out of parts to manufacture cars. So we'll see. Anyway, the internet.
Told you buy an Audi.
You can buy your Audi, but you might be waiting a while for delivery.
The second-hand prices have just gone up.
Yep. Okay. Yes, people who have Land Cruiser 100 and 200 series at the moment are selling them for more than they paid for them with 50,000 or 100,000 Ks on them. It's quite insane. Right. So the instant asset write-off will continue for at least 1 more year, and maybe beyond that. We'll wait and see. We don't like clients making losses. Nobody likes to make losses, but if you do make losses, and there are some clients that have done that, unfortunately, there is this mind-bending rule where you're allowed to take the current year loss and apply it against last year's profit or the previous year's profit if there was one during the COVID years. It's strange, but can happen. And then you get the rebate of the tax you paid in the previous years. You get a rebate of the tax, and you get the tax back this year, which is kind of like time travel, but you're allowed to do it under appropriate circumstances. That was going to close at the end of the 2022 financial year. They've previously announced, and they gave it another rev in the budget, that it's going to go into the end of the 2023 financial year. Okay? So we do have some clients who have got a nice big loss in the, a nice big profit in the current year, but they buy a big asset, instant write-off. The instant write-off drives them into a loss. They take that loss and they apply it against a previous profitable year and get the tax back. So there is a strategy in that space.
What are the eligible assets like? A commercial building, would that be an instant write-off?
It must be what's called a depreciable asset, all right, which is plant and equipment, and typically think of it as movable items. Buildings, no. All right. Walls, no. Okay. So yeah, plant and equipment is the best way to think of it, and it has to be in a business, not in a passive asset. So, just going and buying, a building and installing air conditioning units or something would not typically be right, because the only thing you're getting for that is rent. It's not an active business asset. That's a passive asset. Okay. So there's a whole lot of details in there. There's some catches, there's some hurdles. If you want to explore that strategy, if you've made a loss and you think there might be some benefit, give us a buzz and we'll have a look at it and just map that through on our sheets as to whether you're eligible and what the benefit is and what the conditions might be. But they've extended it for another year, which is probably a good recognition given the number of businesses at the moment that are finding that business is horribly disrupted, with people getting isolated, or people married to or having children who are isolated and then forced to go into isolation themselves as well. Right? We're suffering that in-house ourselves, and I've had one client who's cancelled or deferred appointments for 4 weeks straight. Week 1, child got sick, so they all went into isolation. At the end of the week 1, child number 2 tested positive, so they got another 7 days. Week 3, mum got tested positive, so they went another 7 days. Week 4, guess what happened to dad? All right, so a 7-day isolation period turned for the family into 4 weeks. Just slows things down. They're running a business on that. Fringe benefits tax, this was previously announced, it was last year's budget, but now it's been enacted a week ago. So we've got the law 11 months later, right? You can have more than one electronic device per employee per fringe benefits tax year, which is a damn good thing, because most businesses have had to send their employees home, and they've had to buy them laptops and screens and mobile phones and all manner of things. And this was just common sense in COVID period. It's just taken them 12 months to legislate it. They've changed the rules regarding travel, which was very kind of them, but nobody's allowed to travel anywhere, so that's a complete waste of space there during that period. The big new announcement is rats are exempt from fringe benefits tax. Right. So if you have to do that, or you want to do that to look after your team, give them a sense of comfort, the employer can buy them and claim them and not have any issue. Tax deductible, no FBT. The start dates on that is all now there, so it's all good. Some other little bits and pieces from the previous financial year. Concessions for what small business, it's now, what is a small business? It used to be 2 million or 10 million. Now for most activities it's 50 million, but you have always got to check what that is. There is actually another test. Some businesses it's 2 million, 6 million, 10 million, 50 million. You actually got to define what issue it is to see whether you're small as defined, but they have chunked it up a little bit. Overseas companies, some foreign companies are going to be deemed to be Australian residents. That's so the tax office here can grab more of them. And particularly, and this is now law as of a week ago, the last dot point, which is going to change every business's payroll system in the country. All right. Superannuation guarantee, the first $450, or sorry, let me rephrase. If a person earned less than $450 in a calendar month in your business, gross pay, there was no SGC on that. That 450 threshold is being abolished. So adults earning more than $450 per calendar month, 450 doesn't matter anymore. It's adults earning anything more than $1. So if somebody has to be paid $1 for gross pay for a month, 10 cents goes into the superannuation account on top. Right? 10% super on all dollars from $1. Okay. Sorry, 10.5 is also what's supposedly coming. Melissa's just keeping me honest that there is supposed to be an increase in the SGC rate coming to 10.5. It's getting no press at the moment, so I don't know whether it's going to happen or not. It probably will. Okay, so that one's going to require changes, and if the SGC rate does go up to 10.5 from the current 10, that's also going to mean that every employer is going to have to adjust every payroll system to pick it up. All right? Some payroll systems, it'll be an easy default setting. Some payroll systems, you'll have to go into every employee card and change every employee card, which will be a bit painful for some. So that was individuals and businesses. The other one is superannuation. Now, what was the one word that you did not hear the Treasurer mention on budget night for those of you who are slavishly listening to the Treasurer's speech? Superannuation. They didn't do it, right? And I got hold of one of the media heads at the budget breakfast the next morning, and I said, "You've missed your headline." And they said, "What? And I said, "The headline was no changes to super." That's a headline because for the last 20 years, they've messed around with, I won't say what I was really going to say, they've messed around with super every year for the last 20 years in the budget, if not longer. So a budget speech that doesn't mention super, that's a headline. So we all go, "Oh, phew, haven't done anything." One tiny thing they did announce, and it's a good thing, just before the budgets, this came out, for self-managed super funds, for all super funds, but particularly for our clientele, it's self-managed super funds. The default minimum pension is in the right-hand column here, and your super fund has to pay out that minimum pension on your account balance if you're in pension phase once you hit those different ages. And the minimum pension payout goes up the older you get. The intention of the policy is that you should empty out your super fund before you die. All right? That's government policy. Have they got the numbers right? Probably not. For financial year 22 and 21 behind that, they said, look, there's been a worldwide pandemic, markets have crashed, you only have to take out half your money. So the 4% became 2%, the 5 was 2.5, and you can see the figures in this column are half the right-hand side columns. That was going to finish at the end of this financial year in 3 months' time. They have announced just before the budget, they came out and said, actually, we'll give you 1 more year because there's still question marks and there's a war and all sorts of other things. There's still question marks about the funds and about the performance of areas. We don't want you taking out too much and robbing your super fund down to nothing. Well, there's nothing to stop you from doing that once you're of age. So we get another year at the half rates. Which for some people has been fantastic. We've got some clients who are really loving this. We've got other clients that go, it doesn't matter, Rob, I need the money to live on, I've got to take it out anyway. Okay, so that's all they did on super. Right? So there was really no announcements on super. We'll go, yay! Last year's announcements got legislated last week, as I keep saying. So they cleared the decks of the previous announcements in order, which is unusual. I've seen budget announcements take 2 and 3 years to get legislated. It's quite unusual for them to actually finish them all before the new budget comes. So there are changes. If you're in the superannuation space, no work tests for various different rules from 67 to 74. The work test was a big thing. Now it's a much smaller thing. If you are downsizing your home, right? So you are in a large and valuable home, you're going to move to a smaller, cheaper home. That doesn't happen very often. People often downsize in terms of square meterage, but upsize in terms of luxury.
The price doesn't.
But if you are downsizing, or merely, it's actually misnamed, if you are changing home, you don't actually have to downsize anything, right? But if you're selling out from a house that you've lived in for long enough, there's a whole lot of rules and thresholds and hurdles that you've got to tick. But if you tick it all, you can put some money into superannuation, presumably freed up from downsizing your house, but in fact it could come from any other source that you happen to have money lying around from, as long as it's a trigger of selling a house of some description. Right? That used to be only applicable if you were age 65 and above. Okay, they've now reversed that down, backed that down, and now it's eligible for anybody 60 and above. Right? It's one of the last loopholes to force money into super that it hasn't got too many tests attaching to it. Some, but not too many. Just a reminder, the SGC rate went from 9.5 to 10. I actually came across a business client only the other day that hadn't adjusted their payroll system. It was still sitting at 9.5. 9 months later, they're in trouble. Right? So it is 10. And as Melissa's reminded, it's supposed to go to 10.5 on 1 July. And the SGC we've talked about. So those are all the things they announced last time. Okay. Some of the things that they didn't change. How much can you claim as a tax deduction or salary sacrifice, or your employer can put away for you? $27,500 if you're eligible per annum. All right.
Does that include the 1,500 if you're below? Just out of it.
The 1,500 if you're,
or if you're below 126,000.
Melissa, you're the super guru.
You've lost me.
So if you've got if you can put in 27,500 and then you get the other $1,500 in the government.
Oh, the Lamington.
Yeah.
Oh,
Completely
yes,
unrelated.
completely separate.
Completely unrelated.
So you
Completely
can,
separate.
so you get that if you, so you get.
So that's a
addition.
tax credit.
Yeah.
To do with the income tax system. This is just how much superannuation you can put away.
Oh, so yeah, okay, so it does.
So
So $27,500 salary sacrifice. If you're on a $200,000 salary, the employer is putting 10% away for you already. So that's $20,000. There's only $7,500 left over. Right. If you're on a $400,000 salary, the employer only has to pay tax on pay super on $230,000 of that.
sorry.
The employer only has to put 10% on 220,000 of that, so there will be a smaller arrangement. If you're on more than 220,000, I know some of our people online are, the employer does not have to pay super above that threshold, and that threshold will move on 1 July. But your employment contract might say that the employer has to do it anyway. Fine.
So I think just to clarify, if you salary sacrifice enough to bring your income below the threshold that makes you eligible for the Lamington, then you'll get your $1,500 back when you lodge your tax return.
Fantastic, you got that, did you?
Great question, though.
He knew what you were on about.
Oh, no, so I saw.
You're thinking too far ahead. Very good. It should be accountant.
Yeah, so talk to us before end of financial year for a bit of year-end tax planning and or financial.
We'll get to that in about 5 minutes. Okay. If you want to make after-tax super contributions, you can do that. They're called non-concessional contributions because you're not getting any tax deduction for it, so non-concessional. For this current financial year, you can put in $110,000 subject to a whole lot of other conditions that I'm not going to go into. $110,000. That's coming out of grocery money because it's not being claimed as a tax deduction, so you've got to have that under the table somewhere. Oh, sorry, not meant to say these things, no brown paper bags. Or if you have won the lottery or you've sold a car or a boat or a Land Cruiser, you can grab the next 3 years, the current year plus the next 2 of those $110,000, which means you can shovel $330,000 in one go into superannuation. But then, of course, you can't do any more of that kind of money for the next 2 years because you've used up 3 years worth of caps. Okay? There are catches and caps and limits on that, so just don't do it without checking. All right? Okay. And one of the main things is once your total super balance exceeds 1.7 million, you can't do any of this. Okay? So there are catches, there are issues around that space. Now people go, oh, okay, I've won the lottery, I've got an inheritance, I'm going to shovel my $330,000 in. What do I do with all the rest of the money that I've got, that I won, my inheritance. One of the little tricks is talk to Bob. He's got all sorts of great ideas for you in our financial planning. But one of the little tricks is if you've got even more than that you're freed up, do $110,000 in May or June, then do $330,000 in July. Now you've got $440,000 in over a very short period of time. Okay? So play with that. Bob's the master of those strategies. Been doing them for years. Okay, so that was the budget. All right? And in half an hour flat, we've gone through the budget. I've done budget presentations like this in the past where we've been still going on well past 7 p.m. Right? So today there wasn't a lot in, and half of what I've been talking about was stuff that was announced in the previous year. Right? So pretty boring stuff. We can talk afterwards online and in person here as to whether this budget is sufficient to get them re-elected or not. Your political views on that are entirely up to you. I'm not party political myself. I think they're all completely useless. So that's where we end up. But I am going to talk about some tax planning. I said we'd get to it in 5 minutes. Here we are. So first of all, number one point in time, make sensible commercial decisions. Don't let tax tail wag the dog. All right? Just because you're getting a tax deduction for it does not mean it's a good idea. Okay? The Australian obsession with paying less tax sometimes makes people make pretty silly decisions. Okay. This slide has been basically the same for 30 years. And yes, I've been doing these presentations for that long. It's pretty sad. Okay. Deferring income into a future year defers the tax to a future year. And in the words of the great Peter Clines, the greatest tax avoider in Australia's history, tax not paid this year is tax not paid. What happens next year, we'll worry about next year. Right? So kick it down the road. Right? And this is classic kick it down the road stuff. Okay? Delaying the income into a subsequent year so you don't have to pay it for at least 12 months. And inside that 12 months, there might be an election. There might be a reduction in tax rates. There might not, but at least you've kicked the can down the road. Okay? So private companies pay the dividends in July, not June. Simple stuff, might be able to control that. Delaying bonuses. If you go to your boss and say, please don't pay me a bonus until July, they may not pay it at all. So this is, again, don't let the tax tail wag the dog stuff. Right? But delaying bonuses into the next year throws that down the road. If your term deposits, a term deposit that matures on the 28th of June makes its interest taxable in the current year. Extend the period on the term deposit, or next time you lodge it, make sure it only matures in July. Simple stuff. Right? Don't send out your invoices if you're in business. Right? That's usually a really daft idea. Okay? If you don't send out the invoices, you might not ever get paid, because by the time you do, whoever it is you're sending says, I've forgotten about that, I don't know what it is. They lose it, you don't get paid, yada, yada, yada.
I think it is important to mention that normally we present this in May.
Yes.
When you've only got a month to go. So it's don't send out your June invoices until the 1st of July. But of course, this year, the government has brought the budget forward. So yes, please do keep invoicing.
Yes. And those who don't invoice don't get paid. Your cash flow goes down the tubes. Meantime, you've still got to pay your own bills and your team and all those sorts of things. So this is basically a silly idea, but I do know people do it. I did have a client 20 years ago who confessed that all of his income, in those days, it was largely paid by cheque. I said to him, oh, what's happened? And he pulls open the top drawer. This is on the 2nd of July. He pulls open the top drawer and there's a pile of cheques that he's been accumulating for 6 weeks that he hasn't banked. Right? On the basis of he won't be paying tax on it because he hasn't banked the cheques. We had a little chat around that. One of the other little tricks that trips up people, and I had somebody yesterday in the office that tripped up on this. All right? If you are selling an asset, selling a rental property, selling your business, selling a significant asset, it is the date of exchange of contracts, not settlement. It is the date of exchange that determines which tax year the capital gain falls into. And the lovely fellow I had in yesterday, new client, never seen him before in my life, said, oh yes, Rob, and we talked about tax, and he said, oh good, and I'm just seeing you now, but next financial year, I'm going to have you do my 2023 tax return, which is 18 months away, because I'm selling my property and it's settling in July, so that'll be next year's problem. And I said to him, you've already exchanged on that, have you? And he said, yep, long settlement. And I said, good, it's not going to be 2023, it's going to be 2022, because the date of exchange, you've already exchanged, it falls into this tax year. And there was a lot of wailing and gnashing of teeth and querying, but that's the actual fact of it. I have a barrister who practices in tax law who got this wrong.
So you can't kick that down the street.
So once you've exchanged contracts, you have triggered the capital gain, even if settlement is 6 months, 12 months, 18 months down the road. All right? Exchange of contracts counts. Okay, so be very aware of that. Doesn't matter if it's sort of July, August exchange for settlement in September, October, but typically at this time of year, people on their investment properties go, oh yeah, I'll exchange now and I won't settle, I won't get the money until July, so it'll be the problem. Wrong. Okay, and every year that goes past, we always find somebody. Okay, the other side of tax planning is bring some expenses forward, push the income down, bring the expenses in. So buying plant and equipment, so long as it is installed, ready for use, your instant upfront tax deduction, instant upfront write-off, all these good rules, right? Do that, but it's not sufficient just to have it on order. It has to be installed, ready for use, right? And there are various things that's very tough to get in at the moment. I hear builders telling me that steel, timber, very slow, very long supply chain, very long supply problems, okay? Paying your June quarter, and again, mainly for employers here, paying your June quarter superannuation before 30 June, not after. Superannuation is not sufficient just to have it accrued or have it sitting in creditors. Superannuation has to be physically paid to be a tax deduction. Okay, so rather than waiting until the end of June in payroll and then paying it July, maybe do the June superannuation in June. Okay. Writing off bad debts and documenting, again, as Melissa has said, we would usually be doing this presentation after the second Tuesday in May. The budget traditionally has been the second Tuesday in May, all right? But the second Tuesday in May is when they have to have had the election, right? So they've had to bring the budget forward. Right? There was a whole lot of people running around last year saying, I wonder when the budget's going to be, I wonder when the budget's going to be. And it's like, we know they have to have an election in the second week of May. The budget's going to be in March. And I also can tell you that they booked out the National Press Club for the budget speech 7 months ago. So they knew what they were doing 7 months ago. Right? It's pretty obvious stuff. So in May, we're just before the end of the financial year. So we'd be saying to businesses, and still saying it now, if you've got bad debts, write them off, document your reason why they're bad, kill off any old stock, any old equipment, take it to the trash, get rid of it, put it out the front of a discount bin, but just get rid of old stuff, instant tax deductions for that. Use your FBT concessions. There aren't many, but there are some. All right. Particularly the concession, buying everybody laptops, mobile phones, digital equipment, portable digital devices. If you're going to do something, do it before the end of June, if you can get their hands on the gear. Okay. And for clients that are on the cash basis, you can prepay up to 12 months worth of expenses and claim that tax deduction in the month in which you pay it, rather than having to apportion the expense over 12 months. There are some catches, some conditions around that. Have a chat to us if you have that in mind. And some expenses are not eligible. So bringing forward deductions, that was for businesses. For individuals, it's pretty simple stuff. Pay your self-education in advance, subject to not being HECS. Membership fees, professional library subscriptions, home office expenses. Look, home office, everybody's just using the standard ATO flat rate per hour these days. It's so much less fuss, but you can do it. Prepay your income protection insurance, so rather than paying it monthly, if you've had a big year, go in June, talk to the insurance company, pay the next 12 months in one go. Only for income protection insurance, it's tax deductible. Most other personal insurances are not. Rental property expenses, again, pay it in advance, claim it in the year in which you pay it. Make your donations, the simplest tax deduction at all. Pay your donations and get a tax deduction. You'll get a warm, fuzzy feeling inside. Right? And Peter's sitting here next to me and he's looking at me because he's thinking there, Rob, you and I are both directors of a charity that needs donations. So if you don't have a fascinating charity of your own, we've got one. Right? And this is actually serious, we're not joking. We actually are directors of a charity that is in the modern slavery area, or against modern slavery. Right? And we also have just released, I think it's just released, the chocolate report. So for Easter, if you want to know whether there's modern slavery in your chocolate suppliers, get hold of the chocolate report. If you Google modern slavery and chocolate, there'll be the chocolate report and it'll tell you which manufacturers are good on this and which manufacturers need to improve their act. Okay, so I've done the plug.
Well done.
And it's a relatively new one. This one's been around for only about 3 years. Prior to that, there's 30 years of trouble on this one, but 3 years or thereabouts now. If your employer has put away $10,000, $15,000, $20,000 worth of superannuation for you, and the cap caps out at $27,500, there's a gap. if you have plenty of leftover cash and nothing else better to do with it, talk to us about eligibility, but you can make a personal contribution out of your own money and top yourself up from that 10, 15, 20 that your employer's done up to the 27.5 and claim that as a tax deduction in your personal return. There is a box in your personal return, but it has conditions and issues attaching to it. Right? So have a chat with us. We can make sure that you've topped that up. There's also a related new thing that I haven't got on the screen, which is if you have missed using some of the threshold in the last couple of years, so you've only used 15 of the 25 as it used to be, or 20 of the 25, or 7 of the 25, whatever your employers put away for you, subject to a whole lot of hurdles, catches and thresholds and tests, you can actually catch up on some of those bits that you've missed and claim that as a tax deduction as well. But don't do that without getting advice. There are, let's say, a whole lot of conditions attaching to that one. So pretty simple stuff. For those of us with family trusts, and I know quite a few of our people online will have family trusts, the ATO has been making noise about trust distributions and about having to do them properly and what properly might mean. They put out some significant tax rulings in February, 4 tax rulings on how family trusts should behave on this. The 4 tax rulings they put out in February fly in the face of the tax case that they lost significantly in December. So we have a decided court decision where the tax office took a big loss, and we've got 4 public rulings, draft public rulings, that completely fly in the face of the court decision. Tax office is saying they're going to appeal, or they are appealing the court decision. So this announcement is out there. Wait and see what turns up on that. But we will be talking with our family trust clients about making sure that we just sort of, make sure that there's nothing there that we're really going to tweak the nose of the tax office on. Or if there is, we know that we're going to do it. We're going to do it happily anyway and say, okay, that's how it is. We'll be well advised. Distributions to children. If your family trust wants to give children a distribution of trust profit to the children under age 18, they are good for $416 tax-free dollars each. Okay. Taxable income. So $416. The key take-home message out of that is you did not have children for tax purposes. Distribution minutes. You can allocate different types of income in different ways. If you want to do that, have a chat to us. There's a whole lot of issues around streaming income. Tax officers talking about those things. And the key point here is to have some tax planning meetings with us before June, because those tax distribution minutes for family trusts have to be documented, decided on, and put in place before 30 June. So we've been doing that for 20 years, 30 years. I know other firms that invented after the event, but we've been doing that and doing it properly for as long as I can remember. So with that all said, the best tax planning is done now, when we've still got a bit of time before the end of the financial year. But the best tax planning is also done before a new financial year starts, so that you can work out what is our plan for the next year and perhaps even the year after. Medium-term planning is a hell of a lot better than short-term stuff. And one of my favourite phone calls is the client who phones up by 10 or 11 a.m. on the 30th of June and says, what are we going to do? I sent you a letter about that 3 months ago and 2 months ago. I sent you 4 emails about it. You haven't responded. And now on 30 June, you want me to do that much planning with you? This is not going to be a happy conversation in many cases. Right? Do it early, get your plans in place. Come back to the original statement. Not all tax decisions are good. You need to have a good commercial decision, a good sensible business decision, a good sensible personal investment decision to back your tax plans. Anything else is letting the tax tail wag the dog. And we're not big fans of that. And say, yes, you can do it, but it's stupid. That's not really a good conversation to have. So from 1 July 2022, looking well ahead into the next financial year, that forward planning conversation, is there any way you can avoid getting into the top tax bracket if you're in that sort of income space? Right? Negative gearing of rental properties is still the most effective way of achieving that. It's still boring. It's still effective. It still works. Nothing has changed in this context. And the Labor Party have learned their lesson of the last budget. They're not going to mess with rental properties at the moment. And I've said that quite loudly. All right? Timing of income, kicking the can down the road. We've talked about that. Not only is there the $180,000 income tax bracket, but if your taxable income exceeds $250,000, and there's adjustments, it's not just taxable income, but if your income exceeds $250,000, whatever money you have put into super as a tax deduction or your employer has put away for you, cops an extra 15% tax because you're a high income person. Right? So you might do a fair bit of work to say, well, I'm over 180, but not by a lot. Let's see if we can stay under 250. The difference, if you put the whole $27,500 into super that you're allowed, the extra 15%, that's a $4,000 tax saving if you can just come back under that threshold. Right? And we've got a number of clients where they might be just over that threshold by a few bob, and then we'd make a decision, okay, we'll have the private company pay a much bigger dividend and we'll blow it out of the water this year, so we might have a better chance of getting under next year, or vice versa. Right? Kick it down the road. We'll come well under this year, but we'll have a bigger number next year or something. It's good planning around that. And I talked about doing salary sacrifice super to top up to 27.5. Right? If you are below that $250,000 threshold, but you're a high income earner, the super fund is paying tax at 15% on the contributions. If you're not salary sacrificing it, you're paying 47%. 47 versus 15, this isn't a hard conversation. It's pretty simple stuff. Okay, so with that, the Everalls Group, we've got 2 directors here. You've got our financial planner here. We're happy to talk to you. We have all manner of parts in the accounting firm. We can do lots of things. We've got financial planning, building better business futures. We've got our books and BAS, which is making sure that our clients that aren't very good at bookkeeping can stay in the straight and narrow. We've got mortgage broking, loans broking, business loans, as well as housing, as well as rental properties, all those sorts of things. We do it all. Sorry?
Car loans.
Car loans even, we can arrange all those sorts of things. So how can we do, I could make this slide 4 slides long. I've cut it back to just one, but it says at the bottom, so much more, right? That's the advertisement. As a marketing person, I'll make a really good account. Okay, there we go. So questions? Flummoxed you all? Bored witless? Right. So with that, we'll throw open the bar in-house again. Ask you to please eat the nibblies on the table. For everybody online, thank you for joining us online. I hope you got something out of that. If you have questions, please submit some emails to us and we'll deal with those out of session. And otherwise, wish you all a good night.
All right.
Shall we do Newcastle soon?
Well, boring's good in anyway.
There you go. All done for another budget.
Before we go.
No.